You see, well, we showed you 2% down for the Dow, 1.6 for the S&P, 1.6 for the Nasdaq. So, Fred, I'm afraid it is. Didn't even have to wait for that. It was obviously it's a red. These records seem a long time back. The Dow is now below 23,000. It's down as much as 679 points today. All S&P sectors are in the red, and the Nasdaq is barely out of a bear, and the US oil is at 17 months low. Now, central banks are warning the risks of the global economy. A slew of interest rate decisions. The Fed has raised rates. The Bank of England and the Bank of Japan are keeping rates on hold, where there have been an argument that they should perhaps be moving. Sweden has raised rates for the first time. It's a non-Eurozone country, for the first time since 2011. Still negative, like Japan and Switzerland. But this gives you an idea of the way in which things are moving. HSBC is warning central bank policies in Europe and the United States are some of the top risks in 2019. Ben Laidler co-authored the report and joins me now. Good to see you, sir.
Thank you.
So we'll get to the central bank's role in this misery in just a moment. How much more do you think we've got to go here? The flushing out process that is underway.
So I think we're clearly seeing the investor capitulation right now. And I think that is potentially us building a base. I think valuations are already pretty attractive. I think earnings are actually a lot more secure than the market thinks they are. And this investor capitulation, you have more outflows from equity funds last week than you've ever had. And that includes the global financial crisis. You have levels of volatility we've only seen 3 or 4 times before. And I think the reaction, this reaction to the Fed yesterday was also probably a bit overdone.
Okay, so in this scenario where there is this capitulation, what does one do?
So I think hopefully you've been pretty defensive so far, but I think right now you lean into this. You need to be taking a little bit of risk. It may feel unnatural, but we have a 20% plus equity return on the table over the next 12 months, which is more than we've had in a very, very long time. So I think you need to be maybe adding a little bit of risk back to your portfolios right now.
I mean, you're never going to get it right. Absolutely. Exactly. You're never going to get it totally at the bottom or totally at the top. The central banks in all of this is an unknown here because the Fed tightened. Do you think they made a mistake yesterday? Not so much in the initial tightening on the fourth one, but in the guidance of next year.
I think the guidance could have been better given how sensitive the market is. But fundamentally, I think this is an economy in the US which is growing well above trend, and it's going to grow above trend next year. So, so it's slowing gradually, but I think all is good here. The market is concerned about a policy mistake. So this report we've written, we actually polled investors, what are they worried about? The two things that they're most worried about are a Fed policy mistake and a policy mistake in Europe.
Okay. What policy mistake in Europe would that be? Because he's got to stop buying bonds, and he's announced he's stopped.
So the mistake's probably been made. I mean, I guess it's really the fact that they...
Well, you think they should have continued?
Well, I think the concern in Europe is that so growth is slowing globally. It's been led by Europe. The risk is that Europe gets caught in the next recession.
But if
policy rates at zero.
If growth is only being upheld by extraordinary measures that should have been long past their sell-by date for a financial crisis. I mean, QE was not designed for your average cyclical recession.
I agree. And the US actually, I would argue, has given itself some policy flexibility, right? The Fed is where it is. There's had quite a lot of capex. Europe's what I think you worry about. It's leading the slowdown. It has a lot less policy flexibility. There's a lot more policy uncertainty. There's a lot less growth going around. That's the big concern for investors, and I would second that.
We'll come back to Europe in just one second, but a thought just occurs to me. Can you tell me tonight why what we are looking at is not the start of something similar, if not in as extreme as 2008? And the reason I ask it in these terms is I was around then, as indeed, and at the time, people said, oh, yes, this is just a bit of nonsense and it'll soon flush itself out. Well, it didn't. Right. Why is this different?
Rates are lower. There's more policy there's more policy forbearance now. In some places, a little bit more flexibility. In some places, others. The growth cycle is meaningfully stronger. It's obviously slowing. I would argue it's slowing a lot slower than the market thinks it is. There aren't obvious imbalances sort of out there that, what set us off the housing crisis in.
But how much does this sort of volatility, this down volatility, create a cause and effect? Investors, consumers see what we're talking about and immediately stop or slow down spending, and a downward cycle, a downward spiral is created. The opposite of the wealth effect.
Absolutely, and you could well see some of that. But I do think one of the strengths right now is the U.S. consumer. I mean, unemployment near all-time lows. You're seeing wage increases. Who's deleveraged since the last crisis? Actually, the U.S. consumer. So I think the consumer's fine.
Funny, when I saw your 20% forecast for next year on earnings, its earnings
for the markets,
for the markets, you're a bit of an outlier there, in the sense of others aren't quite so positive.
Yes, I think sentiment has got too negative. I think growth is absolutely slowing, but markets are way ahead of that. They've over-discounted that. I think our economic outlook is, which we don't have a particularly bullish economic outlook, but it's completely consistent with double-digit earnings growth. And I think this narrative that markets are expensive, they were 30% ago. They're not now. I mean, you've had 25% earnings growth in the US, and the market's down 5%. So valuations are 30% cheaper now. Things have changed a lot, and now we're having a sentiment capitulation. I think our ducks are beginning to line up here.
Very good to see you, sir. Please
Thank
come
you.
back and help us in the new year as those ducks decide whether they're going to roll over or fly. We'll talk about it. Thank you. Now, look.